to the second panel discussion of the day, which is the art of lending. In this discussion, the speakers will look at the emerging innovations in the lending and new credit models. Also, looking at the designing policy and practices that are centered around a better understanding of disbursing loans. So to speak on this topic, I would like to invite Aparna Kumar, who is a Chief Information Officer from SBI. Can we have a huge round of applause, please? Now, I would like to invite Subhrangshu Chattopadhyay, who is the Director of Business and Head Strategy, CRIF India. Let's welcome him up on the stage. Next, I would like to invite Sachin Shinde, who is a Senior Director Sales from ServiceNow. And to moderate this session, I would like to call Sumana Sarkar, who is the Bureau Chief, Financial Express Digital. Let's have a huge round of applause, everyone.
Very warm welcome to all of you once again after the short tea break. Increasingly, we are seeing the science of interpreting data that is coming to play on the ways to optimize the art of lending. What do we mean? Here we have this stellar panel of speakers to throw light on that. Aparna, if we can start with you. When we look at lending today, technology has been playing a key role from creating new models of lending to the way loans are disbursed. So if you can elaborate on the role that technology is playing today.
Good afternoon all. Very valid question in terms of how technology is actually making a difference in lending. So there are three aspects of lending, or three levers in lending. One is the customer, second is the institution, and third one is the regulators. So when we look at the customers, we have various segments. And what I mean by that is that somebody who's staying in Mumbai vis-a-vis somebody who's staying in a tier 6 city, how do we treat that customer and how do we ensure that the customer is able to avail whatever he's supposed to be? And with that, currently, if we look at it, customer in tier 1 city or tier 2 cities, they have their own credit history. So for them or for the institutions or anybody who's a lender, it becomes very easy for them to create a credit, use that credit history, and then come up with what options that particular kind of customer can avail. Now let's look at the one who is in tier 6, where there is absolutely no credit history. So how do we ensure that whomsoever we are giving loans or want to give loan, what is the mechanism which will tell us that person will not default? So there the technology comes into picture, where using the AI ML and the other aspects of that particular individual. And what are they, like how he's paying the rent, what is his social media behavior? Third is how about his employment is, whether he's hopping the employment. When you use these parameters and use the AI ML, you come out with a model for that individual. So that is one way of addressing the credit model problem. The second part of it is, which is very coming up quite well, is upon the open banking, right, and the APIs. So how they help lenders across the country, that there is an exchange of customer data. And when they exchange the customer data with each other, you get a quite holistic view about that individual customer. And here there is absolutely no differentiation whether that individual is of tier 1 or tier 6, because you can, any which ways can do that lending to. The third one is we are coming up with the platform P2P model, right? Where actually the financial institutions at times are not involved. So there is a lender and there is a borrower. And based on the risk assessment or profiles that they do, the lending happens. So whether it's good or bad for financial institution, I won't comment on that. But yeah, that is another thing which is coming up. One more thing which is very important is the risk-based pricing. Right now, what does that mean? Today, we give one fixed rate for the kind of loans, and each of them have a fixed rate. Now, as we discussed first, based on the credit of that individual, we can give them a pricing based on the risk capability of that particular customer. So this is about the customer part of it. Let's look at the financial institutions. Financial institutions, to have this entire infrastructure, to put that entire business case for that, and to invest and ensure that they are servicing the entire set of customers seamlessly, irrespective of in which category or segment that customer is. So FI plays a very, very critical role in adoption and actually executing the technology to make it available. And that is currently, or past maybe a decade or so, we are seeing the mobile banking, for example, right? You have a pre-approved loan and you can go ahead and at one click, you can take advantage of that. Like that, it is getting a lot more promoted from a technology perspective. But financial institutions are a very, very regulated body. So what normal fintechs can provide or can do it on their own, financial institutions have to take a very, very conservative approach. Because again, they are dealing with customers' money and they are dealing with the trust, which we spoke about in the earlier session. So can they breach any one of them? No, they can't. And they don't want to also. If at all, for whatever reason it happens, the regulation body has given them a huge penalty. So it's not the intent, but the idea of financial institutions being a bit conservative or a lot more conservative are because of these aspects. So that's my take on technology per se.
So, Subhrangshu, if I can throw the same question to you, your perspective on it.
I think so. First, let's look at the population that's penetrated, right? So if you look at the census, you'll approximately figure out that the census says 62-63% of India's population is economically active in age terms. Extrapolated, it means about 80 crores people. If you look at the number of people who have ever taken a loan, that is now more than 50 crores. So I think the first thing to realize is that the penetration of credit has increased. That's the first paradigm. However, there's a difference in the sense that a lot of the growth that has come in terms of the credit has come from markets beyond the traditional markets recently. Which means you now have customers from cities outside the top 50 contributing a lot to the credit growth. This is good actually, because it means that as we are right now in an interest rate regime that is stable on the higher side, credit growth is happening not necessarily by increasing leverage further in already penetrated markets. Credit growth is happening from newer markets. Fundamentally, that's a structural shift from our point of view. The data that we've seen, it's irreversible. It's an irreversible structural shift. So it brings us then to the question of distribution and risk. The one great thing that has happened with the Jio Mobile is that in terms of a demand from an experience, there is no longer India and Bharat. Everyone wants an instant decision. Not everyone says that decision has to be an instant approval. But if you are not going to lend to me, I need to know that now. Fundamental change in consumer behavior that is driving a lot of distribution designs more and more. That is why you see the redevelopment, the reinvestment that has happened into the banking apps, the banking super apps. That's because consumers are asking for this. Now, when consumer demand moves into this way, there are two kinds of risk. One is, of course, the portfolio risk. Because as lenders, all the models, whether I'm trying to predict 30 plus in 6, whether I'm trying to predict 90 plus in 12, whether I'm trying to predict expected credit losses, those have been built on data, which is predominantly data of urban and tier 1, tier 2, some parts of tier 3. So what happens when the new demand starts coming suddenly from this cohort of customers for whom there's very little data within individual lending institutions? And part of the reason why you see an affirmative regulatory action that is talking about looking at containment of an inherent risk in the personal loan space is because a lot of the newer personal loans have come from this segment on which there is limited amount of data to do risk assessment. So increasingly what we see is evolving distribution models. For example, co-lending. It is a model that suddenly has more appetite. Then you have, as ma'am said, the platform-based model, but the platform-based model with a regulation. And that is why you have the digital lending guidelines that clearly tells the platforms that you are platforms, you have no business getting into lending and credit. That is the second thing. And then, of course, you have enablers like ONDC, which are creating marketplaces which can scale up embedded credit to a very great degree. So, from our standpoint, changes in distribution, because growth is happening significantly outside known markets. Changes in risk management. We are seeing lenders ask more and more institutions like the credit bureaus to say, help us understand this customer segment so that we lend responsibly to this. So the lenders are not saying, I want to lend irresponsibly. They are saying, I want to lend, but help us lend responsibly. And that I think is very good for the ecosystem. The third, of course, is the fact of the digital experience. Whether it is today because of what Jio has done, whether it is because of the co-lending, whether it is because of ONDC, consumers across the country are asking for an instant decision on whether you will lend to me or whether you will not lend to me. Three broad things that we see really happening.
Yeah, so we'll come back more on the risk and the lending platforms that are evolving. But before that, Sachin, if I can ask you, how are these newer technology, generative AI, ML that we were discussing earlier, like their role in the whole lending arena?
First of all, thank you very much, and thank you for the panelists to be part of this. So, obviously, I very well resonate with Aparna and Subhrangshu, what they said. Okay, technology company like us, or for that matter, AI, ML, generative AI, which is newer things, where we can help most of the customers. So as Aparna also mentioned, there are three pillars to the lending, right? One is the customer, the second is the institution itself, and the third is the regulator. These are the So these three are core to any lending scenario. So what technology can do here is, let's say, begin with your credit score, right? It starts from there. What it basically tells you is that you have a traditional way of understanding what's the credit score for your customer if you know the customer. So you should know your customer. The bester way or looking at using technology is that because all these customers are today available or visible in the social media network. They're psychometric, how they behave in social media, how they react to any social media post. You are able to assess whether he is the right candidate for you. So one of the area of understanding whether he's a good customer for you or he's probably going to give some default, one area where we can really get into that conversation, understanding the customer psychology itself. The second area where we play a very important role, as Subhrangshu also mentioned, is data. Because there is lot of data which is available today across, whether within the bank, whether it is outside. If you are able to analyze the data itself, basically predicting the behavior of a customer, and basis the predictive, what you can do is that maybe analyze what has to be done for this particular customer, or maybe decide. And one more point which he was mentioning, the customer is also interested in knowing his real-time information. He may not want to know whether he is eligible for the loan or not eligible for the loan, but at the same time he wants to instantly know whether you are giving me or not giving me. So I can provide that information in real time because the data is available. I'm able to extrapolate everything and showcase what is required for the decision maker. In this case, it is going to be the institution which will decide. The third important is when you as an institution are going to give him real-time information depending upon the products. Now, traditionally, as people mentioned, that because it is a regulated industry, the fixed interest rate is there. But coming with newer age, what is going to happen is that you are going to come up with more innovative products depending upon the behavior. What is the pattern the customer? So you can more personalize the lending platform, right? It may be personal loan or a home loan. Can you more personalize for the customer? So the minute you personalize, he's more inclined to have that, trust and loyalty towards that existing lending company, right? Because he's getting more personalized information. He's more personally touched by the institution, saying that, okay, I will provide you this kind of information at this product, this particular rate or whatever. I am personalizing the lending itself for you. So he feels good about it. But the important, which is the last bucket, all this information, whether it is a great customer experience, whether it is to do with real-time data, whether to analyze social media feeds to give more insights for the institution as well as to the customer, regulator comes into picture. The minute you have the regulator, because the platform is so integrated today, you are able to give real-time feed. The institution itself is able to give real-time feed to the regulator saying that, okay, why the institution is taking this particular decision. And you are able to keep the continuous compliance in picture so that whenever regulator comes with any audit queries or anything, you are having that information upfront with you.
On the, especially what you touched upon, the personalization bit, Aparna, if I can ask you, the whole personalization experience when you talk of in the lending arena, often technology, was conventionally seen as something that will take away the personalization element from the banking experience. So in the lending context, how do you see technology, kind of playing a role? Has it made it more personalized or has it made it more generic?
So it has made more personalized, but again, with the part of the customers or people. As we were talking just before the session, right? Your father, he doesn't like to do anything on the mobile, right? And not just about fund transfer, but probably even for lending. The preference is to go to a branch, talk to the manager, have a cup of tea, then give the documents. So that relationship, that personal relationship, so the personalization from that perspective with that genre will be like that, right? Now let's look at it who are millennials or Gen Z. We don't want to go to branch. we don't want to do anything out there which is very static given to us, right? So what attracts you, right? Every time that I go, based on the organization will give you based on the past how you have navigated the app or the web. But it will also give you option how would you like to see, okay, in terms of the data which is required for lending. Now what, again, today or maybe few years back, some of the institutions had come up and said, put it up there, right? That this is your eligibility, this is what, but it was a very bland thing, right? It won't have the stickiness of particularly the Gen Z and millennials, right? So now what they are doing it from a personalization perspective, they have enough data of that individual. This is for the existing customer. They have enough data of that individual. They throw up the option to them and they are able to pick up what they want to see, how they can communicate, right? The conversational AI which we talk about. That's how they normally can talk. With being here, no need to go to the branch and feel that effect, right? So for lending, it becomes very important how we are able to have the loyalty and the stickiness, because that's important. I don't want to lose the customer who has come, right, till that stage. I want to ensure, and personalization is one of the aspects which really, really helps. And every day you see, every other institution is coming up by using the technology, how we have the customer remain with us, retention, and also attract new to bank guys. Right? They need to know that when they come on board, I don't want to lose them. And that is where this particular aspect becomes very, very important and key.
Yeah, so Subhrangshu, you were mentioning how there has been a structural shift in the whole customer profile, especially in lending this day. So would you say that data or technology is becoming a leveler in terms of, you know, the various customer profiles or various segments of customers who are coming or looking at lending models?
I think as ma'am said, no, data is an enabler. But first, it's very important to realize that you must have data that is recent, you must have data that is usable, and you must have data that is relevant. Let me give you an example. The account aggregator is a great enabler. But if you go to rural markets, you will see that there are a lot of Jan-Dhan accounts. So, if you think simplistically, you would say that using the account aggregator, I should be able to get these transactions and develop a more personal experience than is available today to this segment. But when you go on the field, you will find out that a lot of those accounts are inactive.
Yes.
Correct?
Yeah.
So you have the possibility of data being an enabler. But the first thing to do is not to focus on the tech. It's to focus on the touch. Because you have to work with those people to make those accounts active. Only then can you deliver that hyper-personalization. If hyper-personalization by definition is going to be constrained to only urban India, the metro India, we will never become the economy that we want to become. Because credit offtake, beyond this, credit offtake to MSMEs is what is going to drive us towards that. So we tend to equate experience delivery with tech, and we tend to ignore the fact that for large swaths of our population, it is the touch which provides the enablement. That is a very fundamental thing to not lose sight on. From our side, therefore, we have worked, let's say, with the bank, with SBI, on a project that helps give a greater amount of decisioning flexibility for the SME side. We are focused on working with an assisted account aggregator journey. Because clearly we have seen the impact that combining what I call regulated industrialized data sets the benefit that it can bring. And if you study our regulator relative to other regulators, our regulator is a very affirmative regulator. Let me put it that way. So the future is in the availability of regulated industrialized data sets. The future is in making sure that those data sets are usable. And for large parts of our population, that usability can only come in assisted models, not through 100% tech-owned models.
Yes.
Sorry. Very correctly mentioned about, but the profiles of those customers, right? The touch point for them is Aadhaar. Okay? It is further enabled by, they are further enabled by UPI. Right? So when you look at and you connect these two aspects, you have at least the base data for that individual that you are already having it, right? The third part of it is that customer in some or the other form is having an account in the branch. So we have some idea again of that individual, may not be technical, but that particular customer holds and has given some information. So extending what Subhrangshu is saying, right? You use these things and start building the models, as I mentioned in your first question, right? That you start building the models using this limited data. And these models are absolutely not relevant to the metro or urban population. And that is where you have to have the risk profile based pricing. And that is how the data will really, really help, not SMEs and MSMEs, but also beyond that who are in the poverty line, you know. So that's my take in addition to what Subhrangshu has said.
Yeah, it's very, very interesting. And, you know, like what both of you were mentioning, and if I can pose that to Sachin, you know, the risks and the challenges that you see therein, you know.
So, as both of my respected panelists mentioned, see, so there is this new world which is emerging, which Subhrangshu also mentioned. You cannot rely on 100% on the digital piece of the conversation with the customer. So this is a new word, or it's coined as phygital, right? So the phygital is where the customer is today, right? So you have both types of population, which Aparna mentioned, Gen Z, they don't want to go to the branch, they're 100% digital. And the older generation, they are in the physical world. And coming back to the MSME and the world where you need to have a touch point within the customer, is where most of the technology companies do play. Okay, and if you look at technology is going to play more and more evident role, is giving because the data is available with the bank or for that matter across various data sources, whether it is government, Aadhaar Vault, all those things. What we are able to do with those data is that give real-time information and make it decision making faster for institutions. As he mentioned, like SBI, if you see today is more than 30,000 branches across India. They have the touch point, they are able to touch the customer, they are able to provide more information in real time, saying that okay, what is his applicability. But look at when it comes to regulator is able to give more and more directions to the bank, saying that okay, how they can make decisions very faster and quicker for most of the institutions. But when it comes to end customer, if you look at end customers, they are thinking whether this is the right institution for me, whether I should go. Response time is pretty important for them. They want innovative products, as I mentioned. And this innovation will come only working with more of a digital as well as the phygital work. And you are able to give him more and more real time. And retention, as Aparna mentioned, is going to be bigger challenge for most of the customer, most of the institution. And the retention will only come if you are able to offer him newer and modern products.
As we see lending models today, how the way they're evolving, there's a lot of this cross-selling of products that's happening. So Aparna and Subhrangshu, both of you, but Aparna, if I can start with you on this question, that do you see there a scope of a data breach, or what are the risks therein, or what challenges do you see in terms of, or how do you see, how do you look at maintaining data privacy there?
So when we talk about the cross-selling of the customer or to the customer, right, is again there are two parts. The customer is already onboarded, is my customer, right? I already have entire set of data of that customer, or whatever is needed, right, based on the regulations, his behaviors and all. When I try to do a cross-sell to that individual. He is at a stage, the customer is at a stage where he is already into my system. I'm already showing the entire demographics and the history that I have. From that perspective, there is no data breach. I'm not doing, because I'm giving everything to him or to her, the customer. I'm giving what the customer has provided me, what I have got from outside, and now I'm offering the customer something, right? So for existing, I think unless I'm going beyond my realm of the universe in which I operate, but that is not required because I already have got that data from third party, the social medias and everything. And I see for example, the spend analysis of that. I see that individual is traveling a lot internationally or locally. And I do analysis of all this, right? And based on that, I see, have this particular customer taken any kind of loan from me? And I'm also seeing that that individual's credit card payments, hypothetically, just gets transferred or paid from my bank to some other bank. So all these aspects, when you look at, you offer based on the behavior, based on all this data, you then try to cross-sell to that individual. So from data breach perspective, I think bank is pretty sure that nothing goes out. Now, when it comes to a platform like co-lending, right, it is being told. Now, in that, if you are offering, what is the data that you are giving outside from your bank to that platform? Because technically that platform could be on the cloud, in SaaS, right? Can I share the PII data with that platform? No, I can't, right? So that is where the encryption, a lot of this stuff comes in. In that case, we have to be doubly sure that whatever is going out from my system is absolutely not misused. Absolutely not misused. So hence, how the data is treated in the external platform also becomes one of the criteria when we get that platform onboarded for any institutions, for that matter, particularly financial institutions, right? So the data breach can probably happen when you have this kind of a model. But when we talk internal to the institutions, no, that is something which is definitely taken care of.
Subhrangshu, you want to add to that?
So I think, and whether the bank is a regulated entity, we run two regulated entities. I think the regulator and REBIT, the amount of detailing they put when they come to inspect us as entities in terms of our data security standards, our data layers, our consumer grievance handling procedures, our adherence to DPDP. All of these are actual measures that are ecosystem measures that are in place to say, okay, you may know what you are doing, but we still want this outside-in perspective to be taken in so that the next thing that you do is secure by design, as someone said earlier. So I think that is another layer which you will find in any regulated entity, which therefore means that you have the comfort. Secondly, even if I'm a platform and I'm working with the bank will make sure that my platform adheres to the same level of information security at the bank. That is a contractual obligation. So those measures are in place. Those will continue to evolve with the law of the land.
mentioned that when you are using any third party, right, that is the time you have to be cautious, and very rightly said, it is as part of the contractual agreement, you just not, because you have your own policies also, which are driven by regulators as well as by the security team internal to the bank. So we ensure that the external platform is abiding by that.
So yeah, because as a customer, we go out in the lending world. So these are, I think, some of the key questions that come to my mind. And talking of questions and looking at the clock ticking away, if any one of you have questions before we take forward this discussion any further, you could just.
So you spoke about in future that the rural market has to get involved more. The credit has to spread in that market. Because the urban market is anyway very mature and moving ahead very fast. And we speak about India becoming a very mature third in terms of economy, in terms of billion or trillion of dollars, etc. How do you see the pattern going forward? Is it really achievable? How will we include that part?
I can't comment on whether we will become that economy. All that I'm
No, you see the signs?
all that I'm going to say is, if I were to sit in this room in 2014, about 6.5 crore Indian individuals who have taken microfinance loans would have been new to credit. So in 8 years, because of that business model, you have brought 6.5 crores people into the credit system, right? Now, and once you have the learning, so like you have the learning on UPI, you also have the learnings on the credit side. And therefore, growth is going to happen based on the learning. So, will more credit penetration happen? The answer to that is yes. Will it happen in the right kind of products? I think the answer to that is also yes. Will it happen by us as consumers believing we need to borrow more than we really need to borrow? I'm not convinced about that answer.
What about NPAs? Part of lending is fine.
See, I think it will have its correlation with the overall economic cycle, but we will learn and we will become better. I think that's the one thing that I'm going to say.
The gentleman there.
Yeah, hello. This is specifically to the banks. We had heard in the media about the Chinese apps which blackmail people. Now, obviously, he is using a bank to put in money so that he lends, and he's also recovering money which comes into that bank. Now, throughout the discussions, people have been talking about, we have technology which can analyze consumers, etc. Why don't they just analyze that this account is a fraudulent account? And why don't they proactively inform the regulator that, or block that account? So, the responsibility also lies on the bank. Thank you.
Can I just take that?
Yeah.
So, one of the things that has helped increase the penetration of lending is what the Reserve Bank calls as self-regulatory organizations, SROs, which is essentially industry bodies coming up with code of conduct and saying that this is how we will do this business, and the Reserve Bank vesting their authority in that. The reason microfinance has grown responsibly, one of the reasons is because it has an SRO. And from that SRO experience, on the digital lending side, you have two bodies. One is FACE, the other is DLAI. FACE and Google have tied up to create a repository of apps that Google is going to say is not whitelisted for lending or becoming LSPs. Today, the Reserve Bank has said, as part of their monetary policy, that they are going to set up a registry of fintechs. So, the concern is valid. I think we should draw comfort from the fact that the concern is being addressed through structural measures which will ensure that, as I said, we learn from our experiences and we get better.
And sir, it's just to extend what he's saying. These are the regulatory bodies, right? The financial institutions. We analyze the behavior, okay? I'll give you a recent example. One of the bank was having almost 2000 plus, okay, transfer from one account, right, to multiple accounts. Normal case, right? It was just a 200 rupees transaction. Should that alarm us? Definitely it alarm us. So we get into that space. At times, like earlier conversation, a huge fraud happened, not just from the Chinese apps perspective. That is just one mode, right? That is just single mode in which the fraudster operate. We go much more deeper into the granular level, where we look at the behavior and then we put a hold on that account, right? But there could be some instance, okay, let's be honest and practically, at times we are not able to because the behavior changes. At times a 30,000 5 times gets out, okay, no problem. But that time the customer comes in and tells us this is what has happened, so we block the account. So there are both ways. One is we take care as an institution that how we can ensure the money is not misused by a fraudster. And the second is even when customer complains or says immediately, they call and we immediately put a hold. And we also ask the other banks where the money has got transferred. There are times when it goes to multiple banks.
Just to add for this point, here is where the platform companies come into picture, because we are able to identify anomalies. That is the job of a platform company, where we will realize that there is an anomaly. The minute that anomaly happens, the trigger will happen immediately to the institution. So that is where I initially mentioned predictive is very important. And because it's a platform company, the customer is at the center of the overall transaction, right? And because we are able to detect whether it is in the system error, whether it is a banking error, or whether it is in error from an end customer itself, we will be able to detect the anomaly and pre-alert the bank. And that is where most of the institutions are having conversations around, including regulator, saying that can we have a continuous compliance into picture and have a real-time information. That's what we are helping most of the banks do that.
Thank you. And as the clock's indicating, we need to wrap up our conversation. So Aparna, if I can start with you, like how do you see the scope and the challenges both going forward in data, helping create new lending models, and how to address those challenges?
So lending, we are talking about money, right? And whether it is digital or with the personal touch. Data today is spread everywhere. Okay, it's not just with the financial institutions. You go on any of the online site, you give your credit card information, you say expiry date, you say CVV, you give your address, right? You give your Aadhaar number at times, PAN card. So what is it that is not there outside, right? Which is not available to any of the fraudsters. But what happens is the challenge that bank faces is, we have the limited set of data based on the interaction I have with the customer, be it personal or on digital platform. So I have to ensure, the institution has to ensure that I am not giving that data or breaching that particular customer's trust and securing that data. So the challenge which is there is, the outside world has all this data already with them. So when they try to do, because fraudsters are already like 5-10 steps ahead of us, right? So they very well know, and they have an entire behavior models with them. And that is where they come with various different channels. Nowadays, the biggest challenge we are facing is, earlier there was only one modus operandi, okay, that they will call the customer, they will say this is what it is, your mindset, blah, 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 yes, right? What are they doing now, right? They are now trying to get into the system directly. So instead of having 1,100,000 or 1 million rupees or all, they are targeting much, much more. So here, the data is not something which is of concern. Here, the challenge we face from a digital perspective is how to ensure that that guy is not able to come in, right? The third challenge we face is, as I mentioned, the data is outside, which is available on dark web, right? And that is where they come and they try to, have ransom, they ask and they do that. So looking at it, a lot more are there. So when you look at all these parts of it, it becomes extremely critical for me or for an institution to not just look at only the part of this customer data digitally, but how the external forces are going to come in and actually breach my system and have the access to the data. So that becomes much more critical than we within the institution are securing. We absolutely take care of it.
Subhrangshu, your views?
So I think we will gradually move, I believe, to a regime of data availability through regulated industrialization. I am quite certain about that, because that allows the consumer to be at the center and say whether I want to share my data or I don't want to share my data. So I think the data model is going to move to that. As ma'am said, the current threats will continue as is. Some of them will morph and newer threats will emerge. From a consumer expectation standpoint, and when I'm talking about consumers, I'm talking about the end customer, they will be happy if they are engaged with a decision, irrespective of whether it's a favorable decision or an unfavorable decision. From an industrialization standpoint, I think while we will continue to see one-on-one engagements, the sandbox model that the Reserve Bank has, that I think will evolve into maybe a longer tenor sandbox or throughout the year open sandboxes to solve for some of these use cases. But I think the important point is organizations will continue to have the data, more meaningful data, to take better informed lending decisions.
Yes, one point is, which is very important, even if going forward we have regulations, right, where, as you said, consent based, right? The problem is that data is already out. So what do we do with that? So that is something which today I don't think we have an answer, a very, very clear answer. We don't have a solution for that. And that is what is being misused.
Yeah. So Sachin, your concluding thought on managing the risks?
Yeah. So if you look at it, as both of them mentioned, the data is very much there. So institution has their data. There is this social media data. Okay. The marriage has to happen. Okay. And which is happening as we speak. It is happening on a continuous basis. What is going to change is that once you have this real data, how do you put guardrails around your policies and guidelines, whether it is institution, whether it is regulated industry. So this continuous compliance is going to come into picture on a daily basis. Okay, how you going to take a real-time information, real-time decision basis what is the data available across all the mediums, whether it is social media, whether it is your institution data, or you go back to the government Aadhaar vault, right? These are the three areas where you're going to have the data and merge, make it happen, and then have continuous compliance around this. And that is where people like us are helping institutions to build that robust model, so you don't make a very formal, informed decision whether it's the right customer for you or it's the wrong customer for you. So that's what I have to say. Thank you.
Thank you so much. So it's a work in progress as we hear. Thank you.